Hey, it's time for the Financial Procast. On today's show, no money down? No problem. LTCI rate hikes finally hit the mutuals. Northwestern Mutual would like to help you with your golf swing. And inflation. We talk about the number one question we get asked about cash value life insurance. All of that straight ahead today on the Financial Procast. The Financial Procast, Monday, February 11th, 2013, episode 24. Is that the Saaalus Agency? Web hosting for the Financial Procast is brought to you by The Insurance Pro Blog, where insurance gets demystified. Online at theinsuranceproblog.com. Additional promotional consideration is brought to you by the Saaalus Agency. Safety, security, prosperity. Online at saalasagency.com. Hello and welcome. This is the Financial Procast, episode 24. It's Monday, February 11th, 2013. I am Brandon Roberts.
And I am Brantley Whitley.
Episode 24. You know what that means?
No, I don't know, but I'm sure you're going to tell me.
In 2 weeks, the Financial Procast will be 1.5 years old.
Wow. Yeah, we have done. We have not skipped a week, have we?
Not. Our little baby's growing up. You know what else it means?
What?
It means summer's not nearly long enough because we started the Financial Procast right around the end of the summer, and now I'm halfway to that point, and I still have too many cold weeks left.
Yeah, you do. I don't know. Every week, it's kind of amazing to me that despite the holidays and despite all those things, we've managed to make it.
Mm-hmm.
We've managed to make it through.
Despite Nemo, we're still making it.
I'll give you some credit here because I'm pretty sure if I was just doing this on my own, it wouldn't have happened every week.
Every 3 weeks.
Yeah. I think I'll do one of those.
2 this week.
It's amazing what the accountability of a partner will do for you.
Mm-hmm.
I think we accomplish much more. That's for sure.
Yes.
So what are we talking about this week?
We are talking about several things. No money down mortgages, LTCI rate hikes, Northwestern becoming a golf coach, and inflation.
Sounds like an action-packed lineup.
Which one do you want to talk about first?
Well, let's talk about those no money down mortgages. I thought we got rid of those things.
Okay. See, my problem is I've stapled story number 3 to story number 1, so I got to be careful.
Oh.
And I was too lazy to take them back apart. So
this is raw and unedited, folks.
Later, I'll cry about the snow. No money down mortgages are back. I don't remember what bank. I don't think any bank specifically was mentioned here, but
yeah, BNY Mellon was
okay.
mentioned in there, and then a couple of BOK Financial, which I have no idea who that is.
Which apparently just sells mortgages to doctors.
Evidently, yeah, they're very specialized. And who else was mentioned in there? Oh, Citi. Private bank.
Yeah, of course. There's a bad idea out there in the banking world. Citi's definitely
exactly. They'll pioneer it, right?
It's like there was a car crash. Where's that one attorney?
Exactly.
There's a train wreck in finance. Where's Citi?
Yep.
Yeah. So basically, it's a little different than before. And actually, we're being very facetious. I actually think there's some genius behind this idea here. And it proves that the banking industry has evolved. It only took them 100 years to figure this out. But they've sat back and basically decided that, if we just give somebody money and not ask for any of their money, and we use the thing that they're buying as collateral for the loan that we're going to float them, and that thing drops in value, there's a good chance that they'll just sort of walk on us. So if instead we ask them to pledge as collateral a portion of the total loan in assets that they hold, there's a much better chance that they won't bail on the loan.
Despite the market value of whatever it is they loaned.
Correct.
Right.
So what's going on here is basically borrowers are being asked to pledge maybe 20 or so % of the loan value in assets that they hold on to. So it could be basically, I don't want to say anything, but a high number of things, like their investment account. So if you need 20% and you've got that value in your investment account, you can pledge that. To be clear, this is something that is only being offered people with assets. In fact, I don't know if they actually drew a line in the sand and told us exactly what you had to have, But they're talking about people with typically close to $1 million in assets. So this is not for the faint of heart.
Right. Well, I sort of figured that out by the list of banks that were offering it.
Right.
You're not working with City Private Bank unless.
I love the comment in here. It's such a pitch. A $500,000 down payment, or excuse me, it's talking about it in lieu of a $500,000 down payment here. The pledged assets can remain fully invested, earning returns as normal without disrupting the client's investment goals. Apparently, these people have never heard of a margin call.
That's what I was thinking. That's exactly what I was thinking. It's like, wait a minute. Does no one monitor the value of the asset that they pledged?
Oh, yes, they do, because there was a comment on here that says that if you're going to do this, the assets, the securities that you pledge, have to be held in a brokerage account at the bank.
Yeah.
So this is beautiful, right? Like we can pull their money into our account and charge them fees, and then we can write them a loan and make more money on them. And
sure. Yeah. I mean,
damn, it feels good to be a banker.
I know a little bit about it because, as you know, I was a bank investment consultant at one point in the past, and can't get them to stop sending me those magazines either.
Really?
Anyway, there were times at which bankers would do loans, and the people that were getting the loans at the bank wanted to pledge their investment account or a portion of their investment account as collateral. So I would either get a new account or maybe they already had an investment account with me. But anyway, I would have to go through this wrangling with the loan officer as far as, making sure that they got statements on a regular basis. And there was actually a list, if you believe it or not, there was actually a defined list of stocks that that they could own, and I'm trying to think of the best way to put it. They had to maintain a certain percentage of their original value to avoid a lack of a better way to put it, a margin call. It's not what it was, but technically, but that's exactly how it worked.
Yeah, does
that make sense?
Yeah, it does.
Sense? Okay. So, I knew it was it's always happened, right? This is not a new concept.
Mm-hmm.
It's somewhat new to me anyway in the world of residential mortgage.
Mm-hmm.
I don't know that it's totally new in the way of a residential mortgage, but
do
you?
No, but I also believe that it's something that has not been done for a while.
Right. It's certainly different.
Mm-hmm.
And they make it sound like it can only happen with jumbo mortgages. So.
Well, yeah, they were very explicit on the fact that it was only going to take place with people with assets who were looking to. If you got assets and you only want to buy a $150,000 house, I don't think you're gonna play well in this game. So they're doing it because somebody at the bank's home office looked at this and did the math and said, we can make some money if it's $1 million or more.
Right. So what do you think about it? What's your opinion of it?
I think that as I stated a little earlier, it's an ingenious idea from giving people an incentive not to bail on a loan. And This is the biggest problem that banks run into when it comes to no money down loans. If you don't ask for any kind of commitment from somebody, psychologically there tends to be a tendency for somebody to be much more likely to just walk on a loan, especially when they're underwater. Mm-hmm. And the other observational trend in the banking industry when it comes to mortgages specifically is that some people are nice and they just leave the home, but a lot of them take a lot of stuff with them. And we're not just talking the bed and the dresser, we're talking the fixtures and all that other stuff.
Right.
So it causes it puts in an extra layer of possible protection for the bank, and we all know that they need that based on some of the other things they've gotten themselves into. So ultimately, I don't see it as being such a bad thing. I don't know if it's the greatest thing from the consumer standpoint because there's certain risks that are put in place. I would love to take a look at one of these no money down contracts and see to look specifically at our margin call question, which is a problem.
Mm-hmm. At what point does the value of of my investments that I pledge decrease to the point that I have to put more money in those accounts or
Right.
something. You know what I mean? There's got to be some stipulation.
And you know as well as I do that the mortgage broker is not an investment guy. He's not going to speak to that at all.
No. Wouldn't think that most of them would. I mean, that's just not their cup of tea.
Well, that
Their
and
expertise.
we always talk about the benefits, not the drawbacks.
Right.
This is a sales job, after all. So I think there's
And then coupled with the fact that these are all on adjustable rates as well. I mean, you're not getting.
You're right for the most part. Yes. And that speaks volumes about inflationary expectations.
Right.
But I think that for certain people who approach it with a certain, I don't want to say pessimistic, but a well deflated expectation,
Mm-hmm.
and not the person who goes, "Oh, I can pledge my stock account for this. Sure, why not?" Maybe the person who says, "Well, I've got $500,000 in cash or bonds or something like that," and it's not 10-year notes, but it's something like T-bills.
Mm-hmm.
For that person, I think it's fine. It would also be interesting to see what additional fees pop up when they're asking for no money down, because you know they're going to play the risk card on this.
Mm-hmm.
So when there's less of a down payment, there's always a tendency to prop up interest rates and justify it that way.
Wonder if they'd let you pledge part of your cash value in your life insurance.
Well, you know they would. They
Although
love
they
that
said
stuff.
they want the assets
love
held
that
there,
stuff.
though. So I don't know how they would.
But
But I mean, it's all contractually done anyway.
correct.
So, people have been pledging cash values in life insurance for loans for years.
Mm-hmm.
Nothing different
And
about that.
banks like it because it's
Absolutely.
so stable. And that situation,
You don't run into margin call issues. I mean, you don't have any issues.
Well, not unless you're in variable universal life insurance, but and usually banks won't play with that. But the process of establishing a collateral assignment for a life policy probably circumvents this. I'm sure not all banks are going to be that wide open to it, but
Sure.
there are enough who are savvy enough, who've played the game enough, who would look at that and go, "Yeah, we can do that."
Mm-hmm.
Not saying they will, but I would assume they could make that work.
Right.
Or you could just pull the policy loan and use it as a down payment.
Yep.
One or the other.
There's a lot of ways to slice that, but for sure.
And I'm sure the impact on you from an economic standpoint would be far, far less than the fees you'll pay to the bank for doing it no money down. Just saying.
They don't want us to talk about that.
They were all on board with us and being nice about this up until that last comment.
We were going to get some advertising money, Brandon.
Yep.
You screwed it all up.
I don't know. People should probably run away if we suddenly go, and the Financial Procast is brought to you by Citibank.
That's true. But the Financial Procast is brought to you by.
It's too early for that. It's too early for that.
It's never too early to
You want to do it now?
self-promote.
You want to do it now?
It's always.
Fine.
I've not taught you anything about self-promotion.
Fine. Saaalus Agency. www.saalasagency.com.
You're from Georgia. We call it the Saaalus Agency, but that's.
I've heard it pronounced both ways.
We just want to make sure people can find us.
The joke there is that I named it. So.
Exactly right. So which is it?
I'm pretty sure that if we're going to use our correct Latin pronunciation, it should be Saaalus.
Probably, but if we'd like for people to find it,
But
we
then
might
again,
say Saaalus.
if you're trying to make an argument on how proper Latin is pronounced, you probably should just stop.
Yeah, you think?
There are days when I think to myself, I'm not even sure why I chose that name. And then there was somebody at Guardian who accidentally asked me if it was an F or an S at the beginning, and I thought to myself, ooh, you pointed out a very big flaw I just made.
Yeah.
Didn't think of that at all when I did it.
Yeah, why can't we just call it ABC Insurance? That would be so much easier.
Because I already registered the domain.
God. Yeah. Well, anyhow.
I don't know if there's anything left to say at this point.
Thanks for joining us, folks.
Well, I meant about the Saaalus Agency.
Oh, no.
Spreadsheet, everything. And I mean everything. SaalusAgency.com. Moving on. Long-term care insurance is one of those topics that has, for quite a while, posed a little bit of a pricing issue for insurers.
Mm-hmm.
A lot of them, right? Like the big names, John Hancock, Genworth,
Like all of them, you mean?
Prudential. Prudential's not a big name. They never sold tons, but they've all kind of been through this weird moment where they had to go back and raise their rates. And and we knew that this was possible, right? Because long-term care insurance is only guaranteed renewable. It's not non-cancelable, so they can basically do whatever they feel they need to do that they can pass muster with regulatory approval when it comes to prices.
Yes.
And so we knew this could happen. And for years, there were many, many people who talked about the possibility of it happening, but it wasn't until just a couple of years ago that we started to really see it take shape and people started to really increase rates. Mm-hmm. However, there was one sect of the insurance industry that sat back and said, we don't do that because we price things right from the beginning, and we do everything to benefit our policyholders. And that, of course, was the mutuals. Mm-hmm. So for years and years, the mutuals used to sell their what was considered highly inflated long-term care insurance under the banner of, we're more expensive, but we're doing it right, and we've never had a rate increase, and we never will.
And we're talking specifically about, we should probably tell the people the companies we're specifically talking. We're talking about Northwestern Mutual. We're talking about New York Life. We're talking about Mass Mutual. And would you throw Guardian in there? I mean, Guardian's not in the business anymore.
Technically, it would be incorrect to throw Guardian in there just because, and this is that minutia technicality, the Guardian wasn't issuing long-term care insurance. Berkshire Life was.
Right. A subsidiary, right.
Yep. So, but
they're not in the business anymore.
But Guardian, but Guardian was definitely one of the biggest champions of, we don't raise rates on current business. We close the block and we start a new one.
Right.
So we couldn't throw them in there. So we're talking about the big four: Northwestern, Mass, New York Life, and Guardian.
Right.
And unfortunately, it appears there's trouble in the company you keep.
New York Life, huh?
Yes, they have applied for a rate increase. They've started in Connecticut, but they've basically made it known that they will be going elsewhere. And basically, they are going to be raising rates on two different products. One product will affect 546 policyholders with an increase on average of 21.1%. The other policy will affect 183 holders and will have an increase of roughly 20.7% on average.
Right.
They've cited that much higher persistency than expected, including both lower than expected mortality and that's a weird statement to put in there because they just kind of restated persistency but called it expected voluntary lapses. So lower than expected lapses are higher than expected persistency and lower than expected mortality. In other words, there were a lot of people that they wrote these policies to, and you probably have run into this in the long-term care market. Sometimes long-term care underwriters will state that they can be more creative when it comes to placing business because if somebody's really, really sick, the assumption is they're just going to die.
Right.
So they won't actually use it, so we'll take their money.
Yes. Because, I mean, that's a nuance in the underwriting of long-term care is that they don't underwrite mortality. They underwrite morbidity.
Right.
Which is a totally different way of looking at things. In other words, the real risk is that you're going to live.
If you're out there with a New York Life long-term care policy and you're wondering what policy numbers this is affecting, it is 4,300 and 5,000.
Those are the form numbers, yes.
Yes. 4,300 was issued from 1997 to 2004. Form 5,000 was started in 2002. They actually still issue that policy form.
Yeah. Which, by reading that, I'm sort of reading between the lines, and I could be wrong, but it just sounds like they're basically saying that's everything we've ever written. I mean, I don't know how long New York Life's been writing long-term care business. But, I mean, that encompasses basically every policy they would have written in the last what, 16 years?
Yeah, it's a long time.
And the increases differ on age blocks and some things like that.
Yes. For example, 4,000 and 5,000, the increase will be higher for people who are over 50 than those who are under.
Hey, so I think we should talk about the persistency thing a bit.
Sure. What do you want to talk about?
You mean people actually keep these things?
Well, people who buy these things and assume that they're going to use them might do whatever is necessary to keep them in place.
Yeah. Well, what I really wanted to talk about was I think that people should understand that part of actuarial science, so to speak, right, is that there is a lapse rate that's calculated.
Yes.
An expected, what's the terminology exactly? Expected lapse rate or something like that. There's a certain percentage of these policies that actuaries, in the design of the policy and the calculation of the premium that's needed to meet the obligations, there's a certain degree of policies that they plan on. You're going to pay the premiums for a little while, and then they'll stop paying, and we get to keep the money, and we don't owe them any benefits.
Mm-hmm.
And with long-term care, it just hasn't worked out that way.
Right. The number of people who have stopped paying is dramatically lower than was originally assumed.
Yep.
And so that has thrown...
Turns out that people sign these things and agree to pay the premium. They keep paying the premium.
That has thrown the anticipated revenue generated by those lapse policies way off.
Right. The claims experience increases.
Yes.
Due to the fact that people actually have the policy in force when they need it.
And, part of me wonders about the original logic behind the lapse rate of a long-term care policy.
Mm-hmm.
Because long-term care insurance is oftentimes looked at as sort of the natural progression after disability insurance.
Right.
And disability insurance is known for a super low lapse rate.
Right.
So if that was well known, why would we not assume then that people who were willing to opt for long-term care insurance would then hold on to that product as much, if not more, studiously than disability insurance?
Yes.
And maybe that was the assumption, and it was even way beyond that assumption. But I've never heard anything that made me think that. But just giving a little bit of benefit of the doubt to the original design.
I mean, I can tell you this, and this is only anecdotal evidence, right, from my personal experience.
Mm-hmm.
Every long-term care policy that I've ever sold was sold to a person who dealt with a parent or loved one that had a long-term care event. Well, that
was the marketing.
I mean, these
pitch.
are people that are very passionate about. I mean, they were. I didn't have to do a lot of selling.
Right. They lived it. They knew what it was like when you didn't have it, and they understood, or they had convinced themselves that it was going to happen to them.
Yeah. And so, it was really more a matter of me coming in, explaining to them the nuances and how it works, and the pieces of the puzzle, so to speak, and then them finding, something that fit into their budget that they could afford. And it may not have been the coverage that they exactly wanted to have fully, but it was they made a decision that it was better than having no coverage at all.
Right.
Hey, at least it'll, worst case scenario, this will pay for, 80% of what it would take.
Mm-hmm.
And that sort of thing. But
lots of times,
big takeaway is that every one of these policies I've sold was to people who had dealt with it and said, I don't, I know what I've had to deal with my parents. I don't want my kids to have to deal with it.
Now, I have a question, and you may have a little better insight on this. Well, no, you will have better insight on this than I will. We see these numbers about increases, and sometimes we look at it and we go, "Oh my God, they're going up 20%."
Right,
but,
and we should say, I should step in and say that these increases from New York Life are not the worst that I've seen.
Right,
I mean, these are not. It's 20% sounds crazy, but I mean, I've heard of them much higher than that.
Well, that's where I'm going, because we look at long-term care insurance today at its current price levels, and it's pricey. But if we go back 10 years ago, and we look at long-term care prices back then, it's different.
Sure.
Dramatically different.
Mm-hmm.
And so a 20% increase from a policy that was issued 10 years ago probably still doesn't even match new issue at the same age today.
No, not even close.
Okay, so in that case, yeah, we're seeing increases, and yeah, we knew those increases were possible, but it's still not like backbreaking in many cases.
No, it's not in many cases. I mean, I think I've told you I've had to do these, conversations with people. They weren't policies. These were people that were faced with increases, right?
Mm-hmm.
And they weren't policies that I sold to them. They were policies that had been on the books for years, but for one reason or another, I ended up being the agent that was helping them out to sort through this increase. In other words, and all people really wanted to know was, does this make what I thought was a really good deal not a good deal anymore?
Yeah.
Should I stop paying the premium? And all I've done is I pull out a yellow pad and a pen, and I just say, okay, let's go back. You've had the policy 10 years. Let's pretend that you had paid this increased premium amount for those 10 years. You didn't, but let's just assume you did. What would you have paid in? And just multiply that number times 10, right? And then walk through what the average cost of care would be. And every time it came down to, if you had an event right now where you needed this policy, it still would only take you like 6 months to recover every dollar you would have put in at the increased premium amount.
Yeah.
Now, if we look at what you've actually...
So the risk for the insurance company is still dramatic, despite the fact that they increased the price.
Oh, my gosh, yeah, absolutely. And I mean, there are a lot of ways that people can, at least in most of the policies I saw, people could say, well, I can't afford to pay any more, but can I take a reduced benefit amount?
Yeah.
There's all sorts of provisions there, depending on the company. But, yeah, I mean, the 20% sounds drastic, but in most cases, when I've looked at it and you walk people through the logic of it, it's still a pretty good deal.
I see.
It has been. But what's shocking is that, that we're seeing one of the mutuals have to.
Well, that's the big reason that we decided to cover this. It's something that the mutuals have told us forever they weren't going to do. They're now doing.
Right.
Well, one of them.
We've seen increases from John Hancock. We've seen increases from Genworth. We've seen increases from Prue and everybody else on the street, so to speak.
Mm-hmm.
And we've seen some insolvencies, but not seen any of the big mutuals come forward. So, and it sort of makes you think: is somebody else going to be next?
Well, interestingly, we do know that the state of California has put in place. I don't remember if they actually passed legislation or if they are mulling legislation that basically puts some very stringent guidelines on what needs to be proven in order to successfully affect an LTCI rate increase.
Mm-hmm.
In fact, I just went back and looked, and for reference, Financial Procast episode number 5, we talked about this, and we mused back then, will this help us gain a little more insight into whether or not these rate increases are the result of somebody's true worry over proper financial balance? And we didn't go to solvency because that's really not, I think, where we need to be worried. But serious adjustment to things like AVR, or is this really just a circumstance where people are looking at profit margins and going, that's not high enough.
That's not as much as I wanted it to be. Right.
And we've not really done a lot of follow up on that. Maybe we should. But it'll be interesting to see how that continues to play out now that states like California are helping shine a little light on that.
Mm-hmm. Interestingly enough, it seems that New York life agents will get higher renewal commissions as a result of the increased premium. I thought that was an interesting tidbit to throw in there. Well, I'm not sure if I was shooting for some good PR, if that would be something I'd want included, but
yes, but we should note that this was taken from a publication written for agents, so
yeah.
That was the only thing they were worried about.
Don't worry, guys.
You'll have to get yelled at, but you'll be paid for it.
Yeah, exactly. That's what I was thinking. You're going to have a lot of uncomfortable conversations, but not to worry.
Bring a shield. Or a helmet.
Your commission's going up. Wow. That doesn't create a lot of goodwill for our industry, does it?
For the shirt that they ruin, you'll be able to buy a new one.
Yeah. Exactly.
So how's your golf game?
Not very good, but I hear that the people over at Northwestern Mutual say that they can help me.
Yeah, good news. Northwestern is going to help you with that golf swing. Specifically, driving.
Driving?
Yeah, like starting off, hitting it really far.
Yeah, you got to get off the tee, right?
Yeah.
Mm-hmm.
I don't play golf, so there's really nothing they can do to help me. But
well, that's because you only have grass uncovered, 3 months out of the year. So being a golfer in Vermont is it's kind of like being an ice skater in Georgia.
Every
You don't see a lot of figure skaters from Georgia, do you?
No.
Or hockey players, ice hockey players.
No, can't say that I have.
Nobody on the Stanley Cup team from Fort Valley, Georgia, is there? Didn't think so.
The Georgia Ice Ducks. Yeah, so Northwestern Mutual has been looking at some data from the Society of Actuaries and some of their own research, I believe, and they've discovered that 56% of Americans feel financially prepared to live past age 75.
Mm-hmm.
And this has forced the Quiet Company to spearhead a new project to help make retirement planning more
to engage.
Well, you tell me, because I'm not really sure what the hell they're trying to do here.
Supposedly they're trying to engage Americans and to get them to thinking about the fact that they're going to live longer. So they came up with this whole, I'm just going to call it a marketing scheme because that's all it is.
Game would be the more demeaning way to say it.
9-hole retirement challenge.
And by the way, I'm at the website, and all I get is a big black screen.
So they haven't rolled it out yet.
So the Northwestern Mutual 9-hole challenge really is like trying to play golf in Vermont.
Yep. But it says the 9-hole challenge will use a series of golf-themed questions to access players' knowledge of retirement risk and financial decisions, blah, blah, blah. The 9 topics will include longevity, health care, long-term care needs, market volatility, budgeting, inflation, taxes, Social Security, and leaving a legacy.
Wow.
So what do you think about this? I've already written an entire blog post about it. So
yeah, you have. We don't have to ask you what you feel about it.
And I didn't just pick on Northwestern. I picked on industry as a whole.
And Northwestern's going to kind of catch a lot for this one, but it's we're bringing this up because we shake our head at the entire industry about this, right?
Yes, most definitely.
To a certain degree, this sort of thing is necessary from the standpoint of there are certain people who just aren't going to think about it. The problem that I see, though, is generalistically, the people who Northwestern Mutual most typically wants to go after are much less likely to need this kind of thing.
Yeah.
Right? Like, I mean, the people who tend to ignore this thing, and this is one of those terrible comments that I'm going to make, but,
You're just going to do it, aren't you?
We report, you decide. That was terrible.
That was even worse.
The people who tend to not deal with this thing or not address it appropriately are people who have less money or make less money. And that is certainly not the segment of the U.S. population that Northwestern Mutual is particularly interested in.
Well, it's not the segment of the population they claim to be interested in.
Right. We have some evidence that would suggest otherwise in certain circumstances, but anyway. Right. So it does help drive the point for certain people, I suppose. I'm just not sure that well, you know as well as I do, that it just, why do we got to try and make it, like, play to the lowest common denominator? It's simple, right? Retirement's expensive if you want to do it early. Save money.
Yeah, and here's the thing. I mean, the people who haven't done any of it, that sort of planning or saving, there's not that much that an advisor, and I'll put you and I in that, lump us in there, right? There's not that much we can do to help him.
Right. So for the person who's 55,
I'm happy to sit down or talk to someone and say, okay, these are the things you need to do. But until you do those things, I can't really.
Right. So
there's no magic.
To the person who's 55 and shows up and says, I want to retire when I'm 60 and I could only save $5,000 a year. What should I do? The answer is buy lottery tickets. Because there's very little else that anybody's going to be able to do that's going to make your retirement prospects any better.
Right. I mean, the reality is you need to adjust your expectations.
Right. We're not trying to
stop working.
Right.
I mean, that's all there is.
And there's always going to be the person who says, oh, you're being an ass. But the truth is, I mean, if that's your reality, then the real answer is you just don't retire.
Right.
Right? Like 60 is not your age.
It's not an indictment on. I guess that's the thing that could be misconstrued, right? We're not making a judgment call as to whether you're a good person or a bad person or whatever. I mean, it's not. Your reality is your reality, right?
Right. Yeah. There's no good or bad to this. The truth is, if you're in that situation and that's what you've got to save and that's where you're gonna. I mean, the situation is you've missed the train when it comes to retiring at 60. Not going to happen. Just live with it.
Right. But that's what we'll tell you.
Right.
I mean,
right.
Rather than sit down with you and go.
Rather than
let's
I think we can probably
go through the 9-hole challenge.
Yeah. Right. Yeah.
I'm not going to unfold the financial roadmap for you.
No. If that's your circumstance, I mean, here's what you got to know. And some people think, well, if I bring you through the motions, maybe I'll find more money than I can squeeze out of you. Maybe, but if somebody's 55 and they want to retire in 5 years and they're starting at 5,000, you've got to squeeze very, very hard to get anywhere close to this is going to work.
You tell me you have $100 of discretionary income every month that you can afford to save. I'm going to say, you got a Maxwell House can?
Yeah.
And a hole in the backyard? Because that's probably where you should start.
Is that where we put the money in Georgia? Call it the Bank of Georgia.
You can't really do it because they rust, but too much moisture.
Speaks like a true professional.
There are lots of other ways. But no, I mean, the reality
mason jar. Screw can.
It's a gimmick.
Yeah. Yeah.
And why do we have to do that? That was my whole point was, why do we have to do that?
Why does it have to be a game, right?
Why do we have to overcomplicate something that's not that complicated?
Right.
It's pretty simple.
And how many people I mean, as well as I do that most people look at this stuff as very boring, right?
Sure.
Pretending that it's a golf game doesn't make it any more palatable to them.
And it's not going to engage. If someone's genuinely disinterested, you think that's going to engage them?
Mm-mm.
Really? I mean, someone in the marketing department. The inmates control the asylum, obviously.
Maybe the truth is we even though the industry sometimes gets beat up for it, but there needs to be more doom and gloom.
Well, there just needs to be more truth, right?
Right, but sometimes that truth is very doom and gloom.
It can be, depending on how you take it,
right? Like I've stated, I don't think here, but in other places before, that one of the best sort of about-face questions you can ever ask yourself about whether or not you're doing a good job when it comes to retirement is ask yourself how many paychecks you have left. And I don't mean like think about it theoretically. I mean sit down and figure out how many weeks there are left between now and the day you think you're going to retire, and tell me how many times you're going to get paid in between that point and your retirement date.
Right.
And let's not play I think I'm going to get a big promotion at some point. No. Let's just take your current paycheck now and multiply that by the number of paychecks you've got left.
So take what you know.
Yeah.
To be fact.
And here's the truth, as sobering as it is. Those X amount of paychecks that you got left are what you're going to have to define your retirement. That's it.
Yeah. The ones that have passed don't matter.
Scares the crap out of people.
Yeah.
Because a lot of people look at it as when I'm earning money, there's sort of this infinite supply of money coming in, right? The scary thing is when you turn the faucet off. But the truth is there's a timer on the faucet and it's going to turn off.
Mm-hmm.
Whether it's turned off because you push the button or it's turned off because somebody else pushes the button for you, it's going to take place.
Right. That's exactly right.
Plan accordingly.
Yep.
For the most financially disastrous moment of your life.
Right.
It is, technically. Like, you're going to lose more money then than any other time.
Mm-hmm. Yep, it's true. I don't know. This sort of stuff just gives me that sort of, I throw up in my mouth a little bit when I read it. Because I just don't think you're going to pull in a bunch of people that you wouldn't have otherwise pulled in.
Right.
By using this.
Well, you do realize that once you play the game, you can send it off to other people, like your family members, to get them more interested in playing the game.
Oh, yeah, I'm sure.
Or more specifically, your Northwestern Mutual financial representative.
Mm-hmm. Yeah.
Who can then tell you about all the nifty products he can sell you.
You mean how his paid up at 65 policy can solve all your problems?
Well, that's one of them.
That was low. That was a low blow. Wasn't it?
I like how there was a hesitation there that was audible, right? Like we could tell that you were mulling over whether or not you should continue to say what you were thinking about saying.
I couldn't help it. Mm-hmm.
So we've beat up that little deal more than enough, I think. And,
maybe we need prepaid legal to be a sponsor. I don't know.
Prepaid legal.
Jeez.
We should just find some weird like Nevada Shell Corporation law firm that.
Yeah,
this
perhaps.
episode brought to you by. So, we've gotten about all the usefulness we're going to get out of that, and probably more usefulness than Northwestern's going to get out of it. But anyway,
well, considering they have a black hole for a website,
we got one up on them. Yeah. Now I think we'll talk about the number one question we get asked,
which is,
and I'm very serious. Like more than what is a policy loan, more than what is a life insurance dividend, more than why don't you like gold, more than would you like to join me in a joint venture to redesign the G-string to include a coin slot? The answer is no, by the way. Number one question we get asked.
Brandon's answer is no. I'm open.
Number one question
mm-hmm.
is, how does life insurance, cash value life insurance, work vis-a-vis high rising inflation?
Mm-hmm. Yep, we do get that a lot, don't we?
And Brantley Whitley has decided that he's going to wax poetically about this topic for the next 15 minutes.
Well, look, it's one of those questions you're absolutely right. We get it quite often, and it seems like we get it more often lately than ever.
Yeah.
So it's pretty clear to me that the people, at least our clients anyway, are very much aware. And I will say that I'll give our clients a plug and say that they're smarter than the average bear. They're thinking about inflation, right?
We just spent like 10 to 15 minutes deriding the use of golf analogies to get people interested in retirement planning, and you just referred to our clients as smarter than the average bear.
Well, everybody loves Yogi Bear, right?
Anyway.
I should continue.
Yep.
So, inflation is definitely on everyone's mind. Everyone's looking at the prolonged period of artificially depressed interest rate, or should I say repressed? I think they're repressed. I think interest rates are repressed, not depressed.
Okay.
Because depressed would sort of imply that it's some sort of passive thing that just happened.
Right.
Repressed would sort of allude to the reality, which is that, there's a governing body, the Federal Reserve.
Didn't know you were a lexicographer, but okay.
But that interest rates are being held at artificially low rates, correct?
Right.
So everyone's looking around going, well, we've had this sort of thing going on for 5 years, going on 6.
Something like that.
It can't go on forever.
Mm-hmm.
And eventually rates are going to go back up. And so I'm buying this whole life insurance policy right now, and interest rates are pretty low, and thereby dividend rates have have been lowered from levels that they were just a few years ago, correct?
Correct.
So they're looking at it going, so what's going to happen when rates go back up?
So I have to ask a timeout question. And I'm not going to give you an answer just yet. We'll entertain it as we go through this. But when we talk about inflation, we sometimes talk about interest rates.
Mm-hmm.
But why?
Well, do you want me to answer that question? Or
Yes, well, go ahead.
Well, I could be. I'm trying to keep it as light as possible, but interest rates, as determined by the Federal Reserve, typically are adjusted as they see inflation in the economy. In other words, if prices rise dramatically, then historically the Fed has decided that it's time to put their foot on the brakes and to make the cost of borrowing much higher.
Okay.
So thereby the theory, and I'm not saying it's right. Okay, I don't want anyone to think that I believe this actually works this well. But the theory is that by raising rates, you slow down the economy.
Yep.
That's my second grade explanation of how it works.
Yeah, and that's good. That's good. But see, the point that I want to make by asking that question is to drive a wedge between the people who sort of refer to inflation as a function of interest rates.
No.
Because a lot of people play that way too fast and loose.
Right,
it's not the same.
No. It's not the same at all. Actually, a rise in interest rates is a function of, or a result of, I should say, right?
To a measure taken to combat inflation. And the other
which means inflation already exists by the time rates, because everything lags, of course.
The other point that I want to make to try and help sort of give a much better grounding, a much better understanding of what's going on. A lot of people think that the Federal Reserve sets rates, like they just get together and dictate them. Like the FOMC gets together and says, we want it to be 2% this month.
Right.
That's not what they do.
Right.
They target rates.
Mm-hmm.
By which we mean they either put money in or take money out of the U.S. economy.
Yes.
The Fed has zero control over the actual rate. The only thing they can do is manipulate the money supply to try and move the rate up or down.
Well, the only rate that they can actually control directly is the discount rate, correct?
Right.
Which is
that's the
whole other function.
Right, but that's a very different sort of consideration, because that's the rate at which they lend money to banks on a very short-term basis.
Overnight, basically. It provides overnight liquidity to banks.
Right, but when it comes to the rates that they're targeting, because they're trying to manipulate market rates, they're either putting money in or taking money out of the economy.
And we should note that the discount rate is effectively zero, right?
Right.
At this point.
But it's always been very, very low.
Sure.
For a reason. They want the liquidity to exist.
Yes.
For a bank that needs the money to meet reserves.
Mm-hmm. There's a whole other discussion I'd like to get into there, but it's not the time or place.
So the question is, now that we've laid down that foundation, the question is, how does cash value life insurance work in the face of inflation?
Right.
Because people will come to us very scared about what exists in terms of options to save money when inflation gets high, because the assumption is traditionally that high inflation will stall and possibly depress the stock market.
Mm-hmm.
It'll kill bonds.
Right.
Because the alternative, or the measure to try and stop inflation, as we have talked about, is to raise rates.
Sure.
Or to target higher rates, but to make rates go higher. And if rates go higher, that means par values and bonds are going to drop badly. We've talked about this. The Bondex tells us that not a high increase in rates will give us a dramatically lower par value.
Yes.
So then we talk about what will happen if we see high inflation and then correspondingly high interest rates with cash value life insurance? And the answer, and this is universally true, so it doesn't matter if it's whole life insurance or universal life insurance, it's all going to play out very similarly.
Yes.
If we see interest rates rise rapidly, and that tends to be the question that people ask more than really, because they ask us what happens if there's lots of inflation, but then they further identify or define it as we see interest rates rise quickly.
Yes.
So that's why we spent all that time driving on that point, to make the point that it's not the same thing, but we understand that one will follow the other. If we see dramatically increasing interest rates, which a lot of people think is going to happen, not so much because we necessarily may have high inflation. We may not have, but what we anticipate is that interest rates are unusually low for the inflationary environment that we have right now, which really hasn't changed a lot in the past 10 years. It's gone up, it's gone down, but if we average it out, it's not that much different. And we had dramatically higher rates not that long ago. So why are interest rates so low? And the answer is we've got a federal a monetary policy that's taking place right now that is trying to deflate rates to spur economic growth.
Yes.
So if those rates return to what we would even consider normal, or perhaps bounce up a little higher because we've been holding them so low for so long, what happens? And the answer when it comes to cash value life insurance specifically is not a lot.
Right.
And the reason it's not a lot, and we have to be very upfront and clear about this, not a lot is not necessarily a positive thing from a keeping up with yields kind of perspective, by which we mean if rates increased 50%, let's just say, and let's also kind of temper that with the reality that 50% from 0.5% is not a big jump. We're not necessarily going to see dividend rates or interest rates on universal life insurance rise quite as quickly. And the reason for that is insurance companies have a need to balance their asset obligations with their liabilities. Their liability obligations with their asset yields. And a sharp rise in rates will throw those balances off. And so in order to try and combat that, the insurance company needs to take a little bit of time to get back to that happy sort of homeostasis, and that's going to drag yields a little bit. Now, the good news is, unlike bonds dramatically losing par values or stocks stalling and possibly sinking, cash value stays the same.
Yes.
Doesn't go anywhere. And the yield isn't going to go down necessarily. It's just not going to go up quite as quickly
as you would like it to.
As you would see happening with, for example, certificates of deposit. So the good news is there's a huge hedge against losing any money. So from a principal preservation standpoint, it's very good. The other thing to keep in mind is that there are additional strategies that exist in those sorts of environments where you can stand to make money. And what we mean by that is we've hammered on the point before that when it comes to cash value life insurance, it's extremely flexible from a money in, money out kind of standpoint. By which we mean you can have your money at any time for any reason. You just call up the insurance company and say, I want it. And you can either surrender and take cash out, or you can, in partial surrender I should say, or you can take a policy loan.
Right.
Now, the strategy that was used, and I would say abused, the last time we saw rapidly rising rates was a tendency for people to take policy loans and still collect dividends, because whether it's direct recognition or non-direct recognition, you still get paid something, and take those loans and put them in short duration CDs, which were paying like 12 to 15%.
Right. So you're talking early 80s.
Yeah. So they'd take that money out, they'd drop it into a CD, make a very decent, safe return. Then they'd cash the CD in at the end of its maturity, retire the loan on the policy, and net all kinds of money. So from a rapidly rising rate standpoint, that's a beautiful strategy. Now keep in mind, insurance companies hate it because it forces them to move money to move money that they have or that they'd love to tag for certain investment options into a different category because it's lent out at that point. But it works for you, the consumer.
Yes. It's a very safe arbitrage.
Mm-hmm. Now, at the same time, keep in mind that this is the reason that direct recognition exists, to incentivize you to keep the money in the policy.
Yes.
By having the ability to say, well, fine, we'll pay you more if you keep it in here, but if you take it out, we're going to pay you less. Mm-hmm. It's also one of the big reasons universal life insurance exists, and it's one of the attractive pieces to that interest rates are going to rise, and we'll probably see a sharper increase in yields on universal life policies than whole life insurance in the beginning if we see those high increases in rates. It's really not a statement to say one is better than the other. It's just something to be mindful of. They'll all kind of wash out in the end. But from a strategy to not only not lose money if we see lots of inflation, but for a strategy to take advantage of other opportunities that exist to continue to get comparatively highly competitive yields, it's a wonderful asset to own.
Right. Absolutely.
Unlike having to liquidate a stock position that has been killed by inflation, or having to try and get out of a bond at a significant discount, it's a great strategy. Now, something that we should bring up is gold.
Mm-hmm.
You're silent. Are you scared?
I was thinking about G. Gordon Liddy and
G. Gordon Liddy. The Financial Procast is brought to you by Forex.
I love all the gold commercials.
Isn't it Forex? They're the gold ones.
No. Like Lear Capital.
Lear Capital.
Or Flair. I don't know.
Something like that.
Forex
is the trading platform.
Yeah, that's currency.
You're right. Yep. Lear Capital. We need to come up with some weird, like, very patriotic sounding name and just sell gold.
Yep.
So we bring this up with apprehension because the gold bugs are like violently in love with gold. Mm-hmm. But here's the deal. The idea that gold is an inflation hedge only works from an economic theory of substitution. And that's it. The fundamentals are simply the idea that if inflation starts to rise, people will exit other assets, mainly stocks, and jump into gold. Mm-hmm. That jump into gold will put upward pressure because buying pressure pushes prices up.
Yep.
That's it. There's no other fundamental reason to own gold just because you think inflation is going to be high. There's no internal mechanism to gold to make it rise in price just because prices are rising.
Yeah.
And I know there are some people who are going to try and push back on that and make up some theory about rising prices in gold, and if prices go up, then gold has to go up because it has to maintain some sort of parity with No. It's not true.
So you're suggesting that it's only the hysteria that drives the price up?
Well, here's the problem. Everything works in a market. And just because the price of bread goes up, we don't necessarily see a corresponding rise in gold. So price levels don't affect everything in the economy on a parity level.
Yes.
So that theory doesn't work. We've disproved it many times.
There's not some great equilibrium.
Right. And I beg the gold bugs to stop telling that lie.
Right.
The only fundamental mechanism that drives gold up is the buying pressure that pushes the price up as people substitute out of other assets into gold. That's it.
Right.
And I would challenge anybody to try and take that on from a fundamental economic standpoint and disprove that idea.
Sure. And there's all the people that always have the end of the world scenario deals with, gold is the only thing that'll be worth. I'm like, I'd rather have water and like pork and beans.
Well, I had this conversation, right.
I mean, that's the currency that'll be worth something, right? Like bullets, water, and potted meat. That'll be the currency.
Well, here's the thing. I've had this conversation with many people before about what happens if we have like a catastrophic failure in the economy.
Right.
And sometimes when we talk about it with people from the standpoint of like one of the major names in the insurance industry failing, right? Which would need a catastrophic economic failure in order for it to happen.
Sure.
And the statement that we don't even have to bring up, everybody we talk to says it. If that happens, I'm going to need much more than gold or
a bag full of gold.
Right.
Yeah.
That is not enough of a buffer to keep me from losing my ass.
Yeah, exactly.
So gold is not an inflationary hedge from a fundamental standpoint. It's simply a commonly sought after substitute, but that substitute could fail.
Right. Not to say there wasn't money to be made in that trade.
Right.
Because there was.
But keep the fundamentals correct.
Yes.
Don't assume that inflation's
Right.
going up, jump into gold.
Right, exactly. If you want to play the trade, then play the trade, right? But that's a different path altogether.
Right. Now, do we really believe that inflation is going to be a big deal?
Not for a while.
Mm-hmm.
I don't. Do you?
Not really. I mean, I think that we're going to see rates kind of jump because there's going to be maybe some upward pressure based on artificial repression. But I don't think that we're going to see rates rise nearly dramatically as people have suggested. And the big reason for it is from a fundamental monetary policy standpoint or fundamental macroeconomic standpoint, the forces in place or the mechanisms in place do not play well to the theory that inflation will be on the rise.
We just looked at numbers last week that would prove that.
Mm-hmm.
Correct?
Correct. The other theory,
when we looked at the I'm thinking about the graphs in my head, specifically talking about GDP, including government spending, and GDP when you stripped it out.
Mm-hmm.
It's just not there.
The other theory in my mind, and I've pushed this for years now, is we have an aging population. So more people are retiring every year than are entering the workforce. And when people get older, traditional financial advice tells them to buy bonds.
Right.
And so, and we've already seen this play out, right? Like we have the empirical evidence in front of us. The outflows from stock mutual funds is dramatic. The inflows to bond mutual funds is dramatic. So dramatic, it's gotten a company that claims it never listens to industry trends to make its decisions to suddenly create 3 new bond funds.
Mm-hmm.
Just because.
Right.
The bond market is something that dramatically affects interest rates.
Yes.
Because when money pours into that market, it pushes interest rates down.
Yes.
And so we can talk all we want about what the Fed's doing. If retirees are going to continue to retire or move into positions that are much more significant on bonds, in other words, they're going to enter the liquidity market as suppliers, that's basically what's happening, then all of that money supply is going to keep interest rates low.
Yes.
It just happens.
Yep. As a function, right?
Mm-hmm.
Because overall interest rates are market driven.
Mm-hmm.
And so if people continue to buy bonds, then you're right. It's just gonna keep rates low.
Mm-hmm.
How long, Brandon? Tell me the magic day that they start going up, because I need to know when to put my short on.
Yeah.
I need to know when to start buying those puts.
July 2nd, 2016. I'm hoping that's a Saturday, just so that everybody can look at it and go, he's an idiot.
Can I buy leaps that go out that long? I don't think so. Yeah. So, well, hopefully that answers the question that people have had about.
At least to some degree.
We've given that individual explanation several times, but
yes. So,
hopefully,
in other words, the strategy exists if it happens. We're not big believers that it's going to be as big an issue as some people are making it out to be. But if it does, there is definitely a plan in place to take advantage of it.
Right. There's a plan in place, and it still makes, and to me, it makes, cash value life insurance even more valuable in that regard. Mm-hmm. As long as it's not a variable type policy, right? Because your values, the cash values are protected.
We are
from
so
market forces.
We are so past our normal time.
Are we?
We kind of are, but there's also the question that we get asked a lot, which is, well, what happens to indexed products?
Mm.
And because that explanation doesn't take a lot of time, I think we'll dive into it real quickly. The answer really is, typically, because of the indexing strategy, the market will fall, which means you'll have kind of a weak credited year. But then we tend to see markets regress back to the mean, and that regression to the mean typically means a big push upwards in the market. Mm-hmm. Or the index, which for people who are invested in the market or the index, they just kind of try to claw back to normal. But for the person in the index policy, it means they get a bad year and a super good year.
Right. And in a bad year can never cause them to go backwards. So
right.
They just move forward.
And the ability to take money out and move into a high-paying CD still exists.
Sure.
Or stay in the policy and move to the fixed account.
Fixed account, yeah. Which will probably rise as a result of rising rates.
You bet.
So
it would have to.
You have that flexibility to make those decisions when the time comes.
Mm-hmm.
But either way, you've got a nice safety net.
Mm-hmm.
So, well, I guess we beat that horse, huh?
We did.
Good.
And we did it with several minutes to. Well, we're over our normal hour. But we're a podcast. We can do whatever we want.
Exactly. That's exactly right.
Although maybe we shouldn't use that word because there's a certain somebody out there who's claiming that they own it.
That's why we call it the Procast.
We're Procasters.
We're Procasters.
We own that one.
Exactly.
And on that stunning revelation, I think we've come to the end of today. I am Brandon Roberts.
And I am Brantley Whitley.
We thank you immensely for spending your hour and some minutes with us, and we will see you next week.